evening, everybody. Welcome to this session on Markets in Turmoil. What Should You Do Now by Debashis Basu, who is our founder, trustee, as well as editor and publisher of Moneylife magazine. It's a session everybody's waiting for. The markets have dipped, gone up a little bit today, and I'm sure people want to know where we are headed. I think those of you who are regulars at Moneylife know that we never preach how to catch the top, okay? We're talking about safe and smart investments and whether it makes sense to remain invested or to get out. I think our philosophy, those of you who know us, is that you have to aim for long-term, steady returns that beat inflation. We are not the place to come to if you're looking for multi-baggers and something that's going to make you rich overnight. That's not what Moneylife stands for. And before I begin, I want to thank every one of you who has been sending us messages on the case that we got through the first step with National Stock Exchange's 100 crore defamation. Thank you very much. Many of you have written, responded, posted messages. We've just been too busy to respond to that, but really feel very humbled and very elated at this wonderful judgment, because it's been a path-breaking judgment, not merely for us, but for anybody in journalism who wants to do investigative work. And I think it encompasses everything from individual bloggers who are bold and want to write things, people like us, small organizations, and even the large television networks who are conducting campaigns every day on TV. Before we begin, I think I see many new faces here, so give me just 1 minute to talk about Moneylife Foundation. Regulars have heard this any number of times. We are a not-for-profit organization. We are into spreading financial literacy, and we believe in advocacy for financial consumers or savers. There's a lot to be done. Most people don't realize that anything that you need for people like us who have 2 square meals a day and money for luxuries and money for saving, we are not a vote bank. We are of no interest to the government. So everything that we want when we want to make our voices heard is a lot more difficult. We try to first get people to understand what the fight is all about. That's why we conduct a number of free workshops. This is our 253rd workshop in the last 5 years. We now have a membership of over 36,000. All of you who are members know that it's free. Joining Moneylife Foundation is extremely simple. All of you have those envelopes. There is a form there. If you just fill up the form, it's called a feedback and come membership form. Just fill it up and you become a member, which means that you get access to all the invitations for the seminars that we conduct. And you also get access to all the helplines that we have. We run a tax helpline. We run a legal resource center. We run a credit helpline for people who have problems with credit scores. We also do some railway-related work. So all of it is free. So please take advantage of it when you can. The other thing that we take very seriously is that feedback form, because all our seminars and lectures are based on what people tell us we should be doing. We try and do it quickly. Sometimes it takes time. Sometimes we have interesting speakers who agree to come after a long time. We had a fantastic session by Amitabh Kant just last week. I don't know how many of you attended. I found it extremely inspiring. So those of you who missed it, every one of our programs is there on Moneylife Foundation. Just look up foundation.moneylife.in. Under events, you will get every single video, except maybe in our first year when we couldn't afford to do the videos, but everything else is there, and if you missed a program, you can go there and take a look at it. And of course, if you like our work, then please do donate, because then it allows us the freedom to do a lot more. You're entitled to a tax exemption under ATG. We also have foreign donation permissions, the FCRA, which is very much in the news. We are entitled to get foreign donations. With this, I'm going to ask our Deputy Editor, Yogesh Sapkale, to introduce Debashis Basu, and then we start the session.
Thank you, ma'am. Good evening, everybody. It is my pleasure to introduce our speaker today. Mr. Debashis Basu is the, as Sucheta ma'am has told you, is the founder trustee of Moneylife Foundation as well as founder, editor and publisher of Moneylife. Mr. Basu is a chartered accountant by qualification. In his journalistic career of 30 years, he has worked with most of India's leading publications, including the Times of India, Business World, Financial Express, Business India, and Business Today. He has been a columnist for the Economic Times and now writes a fortnightly column for Business Standard. Mr. Basu was a member of SEBI's task force on the creation of Indonext market segment for smaller companies and has been a member of SEBI's Mutual Fund Advisory Committee. Mr. Basu was recently honored with the Sriram Sanlam Award for Excellence in Financial Journalism on 15th May 2015. Debashis Basu has also co-authored several business books like The Scam and Pathbreakers with Sucheta Dalal. He authored Face Value, Growth Alchemy, and the Plain Truth series on stocks, mutual funds, and investments. Before we begin, may I request you to switch off your mobile phones during the session? Thank you. And may I now invite Mr. Basu to begin our session today?
Hi, good evening, everybody. Just before the program started, somebody asked me, this title is misleading. Markets are not in turmoil. So given the fact that so many people have come at late this evening in this room, and I'm sure many more would come in, I'm not sure whether everybody agrees with the fact that markets are not in turmoil. They are somewhat, and in any case, we all have a little bit of worry in our mind whether this is going to get bigger, and whether we're going to see what we saw just a few years ago, which is called a global synchronized decline that we saw in 2008. I'll share my thoughts on where we stand, and there are several parts to it, or pretty short parts. The first part would be about what we really saw, how much is the decline, what really fell and what hasn't fallen, and so on. Then I'll take you over a very quick 20-year picture of what corrections or crashes or decline really mean and how significant it is, and what are really, if there are any characteristics, common characteristics of crashes, what are they, and whether we are in that kind of a situation or not. And of course, I'll finally leave you with thoughts on not individual stocks, what to buy, that we can't say over here, but a general direction of what works in markets, what works in situations like these, so that you can take your own decision. It's not really a turmoil unless you take a global picture, which is, what's something happening in China and gets you worried. US markets are crashing, Fed will raise interest rates, and what is going to happen to India, and so on. What has happened in India is that we have seen quite a bit of euphoria from what is roughly a pre-election stage right up to January and maybe March, because March was really the peak from where the market started falling. January and March were very, very similar peaks. January peak was, Sensex was 29,800 something, and March peak was around 30,000 something. So they were really the time the market had started falling. Market always moves a little ahead of actual news events. So what you see over there is not May 2014, but January 2014, just not only because it's a calendar year and good time to start with, but also market does anticipate in advance. So it had already started moving up, as you can see, before a new government took over, with a lot of expectations. Many other expectations have not really fructified so far. I have no comment to offer whether it will or it will not, except looking at some of the broad economic numbers, and I'll come to that later. Meanwhile, what has happened is that we are already down about 16% from the peak, but still that leaves us, if you had started investing in anticipation of a significant change from January onwards, it still leaves you up with at least 26%. On all these are Nifty figures, they're not specific individual figures, because overall Sensex or Nifty is a proxy, as we say, for the market. So this is what has actually happened. Now this by itself would not have created so much of a sort of turmoil in people's mind, except that two things have happened. They have come against the background, as I said, of a huge expectation which took the market up and up, from last September onwards, we have concluded that the market is overvalued. September, early October, all right? But that doesn't mean anything. What I feel is of no consequence, because from September the market still went up quite a bit. And this is what happens when expectations play a role. It doesn't matter what I think, what you think, but collectively people felt that no, this is not the time to worry about, because a lot of things are going to happen and the economy is going to revive and earnings are going to revive, and we are going to see these prices which are overvalued would still be justified with subsequent events. When those things didn't happen, the market has started correcting. So one important point is this, is that it is disappointment. The market is now telling us that we are not happy with the way the economy is shaping up. Our expectations have not really been fully met. Apart from this, we've also seen what is now being seen as a severe slowdown in China. Now, in China is still growing, like India is still growing. But a lot of things about China are completely opaque. We don't even, in fact, Western economists don't even believe some of those numbers, and they look for other data rather than a GDP growth data and so on. And the third thing is that a lot of people feel that after about 6-7 years now, the US Federal Reserve, more than that, I think the entire Obama's presidency, there's been no increase in interest rates. And that is going to happen sometime probably this week or a few months later and so on. And when interest rates go up, it's bad for stocks. That's what people believe. It's not necessarily always true, but that's the belief. And that belief is being fed into, all of these 3 points are being fed into these prices. Now, what has really done very badly in this period? 4 sectors, especially. One is the real estate sector. It's very, very sharply down from March 2015, expectation and the reality. Same thing has happened with the metals, which is a commodity sector, very, very important component of Indian indices, not the main indices, because none of the large metal companies now are in the Sensex, but you can see there are lots of large companies like Steel Authority, Tata Steel, and so on and so forth, Hindalco. All of them have done extremely badly, and this normally happens at a time when people don't think that the economy is going to grow very soon. These are the early signs of the fact that people are giving up on growth. It may be true, it may not be true. Third, public sector enterprises. This is a straightforward vote against what the government, it's a straightforward disappointment with what people thought that the new government would do. A lot of reforms would happen, there would be autonomy, there would be more and more companies would get listed, or the listed companies would sell more shares, the government would raise money through what is known as disinvestment. None of these things have happened. A little bit of disinvestment happened last year, or Steel Authority, Indian Oil happened just a few weeks ago, but by and large, the government has missed the disinvestment target last year, and this year, given the current situation in the market and the thinking in the government that we are not going to sell shares cheaply, not much is going to happen over there. Meanwhile, we have not seen any reform at all of public sector enterprises, the manufacturing kind, with the Bharatiya Heavy Electronics, the heavy electricals, the steel authorities, and NALCO and all of those sorts of companies. A little bit of reform has happened with banks, but that is not very significant to improve the performance or the autonomy. Big disappointment was infrastructure. Again, a lot of people felt that this government is going to sort of lay a tremendous emphasis on infrastructure, road building, ports, aviation, and all of that. Nothing really has happened. In fact, the government has gone back on airport privatization, which was decided by the previous government. I'm told a lot of things are happening in terms of road building, but how much of that would get reflected in the index or listed companies, that remains to be seen. There are only a few such companies listed. Which are the sectors that have done very well? No surprise here that companies which have a pricing power, which are export oriented, either of these two or both. So pharma is a sector which is a pricing power. We never shop around for a medicine that the doctor has asked us to buy. We just walk up to the chemist and pay the price and buy it. And the pharma pricing is just gone through the roof. The poor people are really having a tough time buying medicines according to what has been prescribed. Sometimes they take half of the prescription. They say, we don't want this because this is too expensive. Anyway, that's a different story. The fact is that the pharma companies enjoy both domestic pricing power as well as the good ones are able to export. Companies like Dr. Reddy's or Ranbaxy or Sun Pharma or Lupin or so on. Their returns have been fantastic, 50%, and if you ask a pharma company, where is the turmoil? It's actually up from March 2015. Index is down, Sensex is down from 30,000 down to 25,000 or 26,000, but pharma sector is actually up. Consumption, CNX consumption, whole lot of companies have done very well. They continue to do very well. This is a consumption story, has been the story from 2003 onwards. There had been a little bit of dip after 2008-9, but then it picked up again. It's not a positive return, but certainly it has beaten the index fairly well from March 2015. Two more sectors. One is FMCG, again beaten the returns, and as well as IT sector. The IT sector has been going through a very difficult time. Fortunately for them, the weakness in rupee, which is eventually is a reflection of the weakness of the economy, finally has helped them. And in this last bit of decline, serious decline that the market has suffered from March onwards, the IT sector has not fallen as much. This slide is just to pique our curiosity. It has nothing to do with them. These are all look back. You're looking back and sort of feeling jealous about the fact that anybody who had bought Britannia Industries would have done extraordinarily well, or Torrent Pharmaceuticals would have done very well, and as well as Imami and Aurobindo Pharma. But the interesting point about this is, once again, two are FMCG companies and two are pharmaceutical companies. So we come back again and again to the fact that these are the sectors or these are the companies which utilize their capital well and which have some kind of a pricing power, or what is popularly nowadays discussed as some kind of a moat. They're a fortress around which there are moat, and it's not easy to penetrate that fortress. You can't set up a Britannia tomorrow very easily. It's going to be really tough for you to do that. So they are relatively immune to which are the stocks that have done really badly. No surprises for guessing. All are either in infrastructure or commodity businesses, and they have just got completely decimated. Real estate, power sector, this is steel as well as power, and that of course is a company heavily indebted, Jaiprakash, which is really in a bad shape. Now, question is that we've seen a bit of a decline, and the market has just now stabilized from a situation from 24th August, when it seemed the world was coming to an end, and Dow Jones opened 1,000 points down in the evening, and everybody felt that we are probably going to see a situation like 2008. So the question in everybody's mind is this going to go on? Are we going to fall much, much, much further? Are we so overvalued? There's no growth. What is going to happen to stocks? Now, according to me, there are three kinds of declines one could see in the marketplace. And I'm just going to take you through quickly through some of the phases. Not every single phase has been identified. Not all phases will stand distinctively with each characteristic, but roughly, in the market, nothing is like a formula. It's a matter of approximation. It's a matter of getting it right roughly. So I'll take you through some of the quick corrections. Again, look back. This was October 99 to November 99. In just a matter of 18 days, the market fell by a sharp 16%, just 18 days. And here we are talking about a 16% decline from March to September. It's 6 months. It's been a rather slow decline, but these things can happen. And then, of course, from this point onwards, the market shot up to a high of February 2000, when the eventual peak was formed. January to October 2005, All right, this is also a phase within a larger bull market. Of course, all this you know when only by looking back, not looking forward. But still, for the sake of understanding what can happen in a marketplace, 21 days, 9% decline, 12% decline over 52 days, 13% decline over 24 days. These are the kinds of decline that can happen fairly regularly, no matter where the market is headed. This doesn't mean that the market has started crashing or we're going to see a recurrence of what we've seen, but a sharp decline is in the nature of the market. All right? Anybody who does not familiarize himself or herself with this should never buy stocks. Just as simple as that. The stock that you own may also decline this much, may not decline this much, or even decline much more than this, depending on a specific event that is affecting the stock that you own, and if it fits in with the overall factors which are causing the decline. For instance, if it's some global factor and the stock that you own is somehow linked to it, and this is a story I'm never tired of telling. This is a story of, I think, September 1998, when Russian crisis had happened. We don't even remember what is a Russian crisis. It was a huge crisis in 1998. Russia was about to go bankrupt. And I happened to be sitting with the CFO of Hindustan Lever in their office here in Back Bay. And he showed me the NSE screen. Hindustan Lever was on lower circuit. Lower circuit, there were no buyers. It was down 8%, locked in lower circuit, there were no buyers for Hindustan Lever. You would ask, what has Hindustan Lever got to do with Russia? At that time, Levers was exporting tea to Russia. And tea formed only about 5% of its total sales, of which exports formed even a smaller percentage of the sales. But because there was a turmoil in Russia, people here started selling levers, and that's how markets work. That's how your stocks, even the best of chosen stocks, will go down once in a while in situations like this. January 7 to 2007, this is a time there was a lot of turmoil in the market. A lot of things were happening simultaneously at the same time. There was a big issue in China even at that time. There was a big issue in the US because of the mortgage crisis that was slowly unfolding. First it was sometime in February, then sometime in July, and then eventually the Fed came and reduced interest rates and the market shot up. The global market shot up at that point of time. So even then, in that entire period between January to December, you had a 15% cut, 15% in just 26 days. 1 month, 15% of the market index. The stocks that you may be holding, maybe even more. 11% in 28 days, 6 to 9% repeated declines in just 6 to 8 days. So this can happen anytime in the marketplace given a set of global and local circumstances, either or both. Next comes much more bigger declines and a little more prolonged. It's not a matter of 28 days or 15 days or so and so. Usually driven by events. Something that happens which shakes the confidence of people in the market, right? January 2004, we don't remember many of these events, but this is an event almost everybody would possibly remember. This was a huge decline, 29% over 4 months. The biggest decline, of course, coming on a fateful day when the NDA government lost and the UPA government took over. The big decline coming in on that day. But from January onwards, the market was overvalued. Elections were coming. People were selling. It just went up a little bit with clear hopes that the Vajpayee government is going to come back. When that hope turned into a big disappointment and completely unexpected event, big declines like this always is a shock and a surprise to the market, something which you just never imagined would happen. Everybody is a seller at that point in time. Get me out first, they'll think later. All right? And even if you are not it's very difficult to keep cool in a situation like this because, from everybody in the media, from television to newspapers, the guy next to you, your friend, everybody is saying, is it going to be really bad? What's going to happen? We never know. So their broker is always there at that time with a very helpful advice. Sell now, you can always buy it later. So that everybody is getting the same advice from the brokers, so everybody is rushing to the exit door. It accelerates the decline even more. The more it accelerates, the more those who try to think back, think a little bit and try to do something more calmly, they said, listen, I didn't sell at that time, it's gone down further, so now I'm not going to wait any further. This is all human emotion and human behavior. That's how it works out. May 2006 to June 2006, in a matter of roughly about a month and a half. It started from beginning of May and ended in middle of June. Now, unfortunately, this is not an event which drove this kind of a decline, but I've still put it over here because it was a major decline. It was a 30% decline in just a matter of 35 days. Okay, 30% is huge. Normally, many of these things are just bandied about, people share, there's no meaning to it, but normally people say 20% decline from top is the beginning of a bear market, for instance. Now, doesn't mean it's true, nobody has tested it. If you have to test all the 20% declines and see what has happened subsequently, you will not find any sort of correlation between the decline and a subsequent market movement. But still, 30% in 35 days is frightening, and there's no event. There is absolutely nothing that you have to go back, check the papers of that time to figure out what happened. If you ask me, we had launched Moneylife at that time. We launched Moneylife in March 2006, all right? And we had done a cover story in April with a very dark picture saying, markets something is going to happen. We are just pure lucky. Not that we foresaw it, and not that we foresaw a 30% decline. All we were saying at that time is that the market is very expensive. That's about it. And an expensive market does correct from time to time. But still, for this kind of a decline, there is no event, no explanation, but it did happen. Now, this is all about phase 2, which is bigger decline, and usually over a longer period of time. Third is what we all should be scared about. Why we should be scared about this? Because these really decimate your wealth. Something that goes down 50% has to go up 100% for you to break even. It's as simple as that. If 100 becomes 50, 50 has to become 100, it's a 100% jump. So it's really tough when markets fall 50% or so. Everybody who does not invest in stock markets, they come and say, see, this is why I don't invest in the markets. It's like QED. You should always stay away from stocks because nobody knows. You get all kinds of wrong advice, and markets are all manipulated. Global markets, the conspiracy theories and all kinds of ideas are bandied about. But the really painful part is that this can extend. It can extend over months and really test your faith and belief in everything from capitalism to the stock that you own to the management that you admire and the dividends that you got accustomed to. For instance, 94 to December 96. See the period. It's more than 2 years. It's 2 years, 3 months, all right? And it doesn't mean that December 96 was a bottom. This was a particularly bad period for Indian markets. And for all those people who tell you a chart of a 17% compounded annual return, the answer is the market did do nothing on a point-to-point basis from September 94 all the way to April 2003. For 9 years, the market really struggled. But we'll stick to the first part, which is a big bear market. 2.5 years and down by 43%. Okay, if it's short 30% of 35 days, we don't mind because we're willing to wait and it sort of goes up. But this, both time as well as price. And that was a period in 94, March was the first peak and then September was the secondary peak. That was a period where India was being discovered. This is a 92, SEBI came, and towards the end they formulated rules for FI investment. 93, FI investment started trickling in. 94, they all discovered every Tom, Dick and Harry had a prospectus, was in London and raising money from the FIs, whether it's Core Parentals or whether it's Arvind, many of them have disappeared now. These are names that you won't even remember anymore. Himachal Futuristic first round, then they came back in 2002 onwards. So this was what you call a true euphoria, 94. And if something like this happens, we will know. We will know because the market P at that time, even though BSE P calculations subsequently were found to be faulty, even then the market P at that time was 45 or so. Now today's market P is 24, 23 or 22. So which means double. So if your Sensex is 25,000, it would have been 50,000 today for you to really worry about it. I'm not saying you should wait for 25 to 50,000 or so, but this was the kind of overvaluation, and my subsequent slide will tell you this is one of the major characteristics of a subsequent bear market. If you have huge overvaluation of this kind, which we have not seen after that, Japan has seen even more. So a lot of people who know a little bit will tell you, show me a SIP in the Japanese market, it's a systematic investment plan, they'll tell you. And it hasn't worked. Show me stock markets in Japan over 25 years. It hasn't worked as well as in India. But they start from 87, when Nikkei P was almost 100. The world has not seen that kind of overvaluation except a little bit in Nasdaq in 2000, and also gold, which was about a few years ago, that is 2011, which is a crazy kind of overvaluation. Subsequent returns are going to be zero or negative. It can be a wait for years together, and this is a period when you really have to be very good in picking their stocks if you want to stay in the market and make money. Even in this period, a lot of companies actually went up, but we leave that for another day. Short point is that this is a bear market, and this bear market started with certain characteristics which I'll explain later. Second, February 2000, when Nifty was, when Sensex was around 6,000 or so, and fell all the way. This is the first period I've taken. I've not even taken the prolonged part, which is a 51% decline over, I'm sorry, this is a mistake, that is September 2001, all right? So it's a 51% decline over 1.5 years, 1 year, 8 months or so, okay? A lot of things happen at this stage. First of all, that was another gross overvaluation. Nifty Sensex P was close to 26 or so to start with. Only a small number of companies had participated in the run-up. There was a hint of scam as well. Ketan Parekh scam, money coming in from other sources, getting channeled to stock market. None of those things are happening today. And eventually, global factor, which is a 9/11, which really made the market go down sharply over here. This is September 23rd. I mean, 9/11 happened on 11th September, all right? So here was domestic factors, global factors, which was overvaluation of dot-com stocks, Indian IT companies. Wipro was valued at 100 P at that time, and Wipro has not gone up to that level even today, all right? Even after 15 years, Wipro hasn't gone up to that level. So gross overvaluation internationally, India, nothing happening in the domestic domestic Indian economy in terms of reforms, economic growth, and so on. And eventually, final blow was again a global factor, which brought the market down by 51% over 1.5 years. Now we are looking at this entire period, and we are saying, we would rather wait and buy the stocks when they're very cheap. But my subsequent one of the slides will show that if you ask me, I would have said somewhere there in halfway is a time that we should start to buy. Okay, even with hindsight, I would still say that would be the start to buy good stocks, good quality stocks, not the market, not the Sensex. Point is that even after you think that the market is reasonably valued, even then over a short period of time, over the next 1 year, market can do something to really give you a kick when you least expected it. Now, January, the third big decline, January 2008 to October 2008. Once again, and this is a story that is now for the two bear markets, this is a common story. Once again, originating abroad. This is a story where everything originated abroad. The money came from abroad to fuel this bull market. The money came in 3 different ways. The most obvious way we know is the foreign institutional investors investing in the stock market, which is one of the things that happened. The second way money came from abroad was foreign direct investment, which was booming at that time. And foreign direct investment doesn't affect the stock market directly, but affects indirectly. Because if money is coming to manufacturing, obviously a whole lot of downstream industries, whether it's ball bearing or steel or cement or whatever, they take advantage of that kind of growth. The third, completely undiscussed part of the boom that happened in 2005, 6, 7 and culminating in January 2008 was the money that came into the real estate sector. There is no official account of this because unlike FI investment, nobody is sitting and calculating any of this data. Maybe RBI has the data. RBI certainly has the data because this money comes in a very structured fashion. By one estimate, this was an estimate sometime in 2009, $40 billion of money, foreign money, had come into the Indian real estate. Now that created a massive demand growth. This was a money creating demand, not demand itself. Obviously, India always has a certain amount of demand because it's a growing country. It's got a large population. There are a lot of younger people who are coming into the sort of workforce, buying property, apartment, and so on. But this is the money that fueled the subsequent demand. I remember I was sitting with, we both were sitting with somebody who was very close to the Reliance Group. And this was December 2007, all right? December 2007 was a few weeks before the peak, and a peak that led to a 60% decline in 9 months, all right? So this guy is very close to Mukesh Ambani, and he's telling us that people are dying to invest in India. We do not know where to take the money. We need new vehicles to take the money, all right? These are the Arabs. Now the Arabs want to invest in India. Now this is, it's not a comment on him, but this is a comment on how investors behave and how even institutional investors behave. They behave exactly like you and me. When something is moving, they want to just ride it. At that stage, and especially when, as I said, what works on the downside, exactly the opposite works on the upside, but the same human psychology. If you missed it, then you get all the more sort of head up, I need to get in now, find a way, all right? So that money was all interested in coming into real estate, even in December 2007. And the index P, the Sensex P in December, was 27. Now, when the P is 27, it does not mean that you're going to decline by 50% over 9 months. It only means that your next 1 year, 3 year, 5-year returns are going to be 0 or negative. That is absolutely guaranteed. You would be really lucky with a positive return over a short period of time, 1 year, 2 year, 3 year, maybe 5 years, but certainly over a short period of time. In this case, what happened with overvaluation, of course, now we know, is a scam of epic proportions in the US, which is the mortgage scam, which broke, which took down institutions like Bear Stearns, which took down institutions like Lehman Brothers, and it was like a crisis every day. It was a global synchronized decline. European banks had an exposure to mortgages in the US because they behave exactly the same way. US mortgage market is hot. People are doing these CDOs, get us in. Swiss banks were desperate to, German banks were desperate to get a slice of the action. So they all invested in it, and they were all going down, and they were all panicking together. If the big guys panic, what happens? India, sell first, and you think later. India is nowhere in the picture in the global scheme of things. So prices started falling. Prices started falling, then obviously no fall or no rise is ever linear. There is always some positive factor or the other which comes in. Either the market gets oversold by itself, there are no big committed sellers, so it goes up. When it goes up, people say, oh, this is the bottom. There are more buyers coming in. When more buyers come in, the buy prices go up, then others get convinced, then they start buying. Eventually, the reality strikes once again. This is how the prices decline in a step ladder fashion and not in a linear fashion. Eventually, by 2008, October, when the market was severely undervalued, the market sort of reached a decline of 60% on 9 months, right? Now, one painful thing about these kind of market declines is that it spares nobody. It doesn't matter whether you're holding Hindustan Lever or you're holding a Nestle or a Titan or a Sun Pharma or whatever. It doesn't matter. Because you are against large institutional investors who have to sell. Many of them are reluctant sellers. How does it work? They have raised money from the investors. Those investors say, I don't care, get me out. Get me out of India, or get me out of this stock, or return my money. All right? So at that stage, the fund manager gets a call saying that there is a demand by so and so, another big institutional investor. Maybe Deutsche Bank has invested with Goldman Sachs, let's say. A Goldman Sachs guy gets a call saying from his dealer saying that Deutsche Bank wants the money back. So he just has to sell. He doesn't care about the price. He's not going to argue with his investor, please hold on. He's going to get a tongue lashing saying that, how come you didn't tell me in January to sell? Now I want to get out, get me out. And he's got a discussion going on inside the company, the board and this and that, and everybody is asking. Nobody has invested time and effort to figure out what, when, etc. They said, please get us out, go cash, buy US treasuries. The biggest demand at that time is of government bonds, government paper. So they are reluctant sellers, but they are sellers. Doesn't matter what. When the same thing happens to Indian mutual funds, which are a smaller force, but now they are becoming a bigger force, same story. You and I will call up, we'll have plenty of influences in our mind. We have no guidepost because this thing is unprecedented. You got a job a few years ago, somebody asked you to do a SIP, you were doing SIP, and suddenly you see markets going down, papers, Open Times of India, big bold headline. What to do? You ask your friend. He said, I think you should get out once. I don't know about, I think better to go cash. So it plays on your mind. You have no other guidepost. You call up the fund and you send an email or whatever. You send them, give my money back. The fund manager, who knows better than you, has no choice. He just has to sell and return your money. This is how the spiral, the downward spiral starts. And goes on increasing, because those who, as I said, to repeat, those who haven't done it, their prices are down further, so then they start doing that, the same thing. And eventually you get a market bottom which is significantly lower. Now the point I was making is that this spares no stock. This does not care a damn about whether you are a Tata Consultancy, TCS, which was down 56%, Titan, which was down 48%, HDFC Bank, which has nothing to do with global mortgage crisis, nothing to do. In fact, I remember in just after Diwali of this, during that crisis, October, I think in November or so, November or December, we were meeting Aditya Puri, and he told us that my point of purchase use of my cards has been the highest in this Diwali. Highest. But who cares? Who wants to listen to the analyst who will probably, like me, take the story back to his office and tell the fund manager, I can't do anything. Nobody is listening. The investors are not listening. We have to sell. And in any case, retail investors do not have access to this kind of information. So, which is why you have companies, Dr. Reddy's, I've taken 4 random companies with different kinds of exposure. This is a pure 100% domestic exposure, HDFC Bank. It's a moat. You can't create an HDFC Bank in the next 30 years easily. Nothing has changed in that bank between January and December, yet the stock is down 45%. Same with Titan, same with Dr. Reddy's, same with TCS. 4 different sectors, same story. One banking, one consumer, one pharma, one software. All of them down 50% or so, which is the kind of decline the market has suffered. Now, can we identify a this kind of a situation beforehand. What are the characteristics? There are, as I said, to repeat, the market is not a product, market prices and market movements are not a product of any formula. Some things work more often than not. So we need to pay heed to those factors. So I've just put together a list of factors. If you see these, you should be worried. Within this, the single most important factor is, of course, the overall market overvaluation. Because whether an event like this happens or not, whether the Prime Minister whether the Parliament is attacked or not, or something happens to your PM or not, whether there's a mortgage, these are events, when there's a mortgage crisis in the US or not, if there is overvaluation, a gross overvaluation, your returns are not likely to be high. That is almost axiomatic, and we have tested this over different periods of overvaluation in India as well as abroad. Usually, it is towards the end of a long uptrend. You would have seen, maybe 3 years or 4 years, which is what happened last year. 2003, April was the bottom for the market. 2008, January was the top of the market. We really had almost an uninterrupted 5 years of rally or so. This is unlikely to happen in India very soon, and I'll come to those reasons shortly. But usually, if there's a long period of uptrend, which over multi-year uptrend, you need to think. From an extremely expensive, it will go down to extremely cheap. This is going to happen, and I showed you the previous chart, and I'll show you the actual numbers very soon. There's going to be a lot of fundraising. This was a characteristic of 94, this was a characteristic of 2000, this was the same characteristic of 2007, 2008. A lot of companies are very easily, publicly listed companies are very easily able to raise money. People are desperate to fund them. As I was telling you, $20 billion are waiting to come into India from the Arabs and so on in December 2007. All right? People are desperate. Retail participation is a dicey thing, but usually when there's a lot of chatter and people are dying to get into stocks and discussing stocks with each other, then you need to be worried, because usually a lot of these people come in towards the end of a bull market. They are not bothered about when stocks are cheap. They are bothered about stocks when everybody is talking about stocks, which is usually point number one, which is towards a long uptrend has already happened. Lot of stocks which have been hot will sport a PE of 50, 60 and more. This is a story in .com in 2000. This is also the same story in 2008. So when you see, even good quality companies will become grossly expensive. 50, 60 PE would be fairly common. So that's the time to worry about. Overall market PE would be more than 25 times. 24 actually. 24, 25 times overall market P, and this is very easy to find out. You can go to bseindia.com or nseindia.com, and there are pages where you can check market P. All right, and this is based on last four quarters of earnings, which is calculated. There are a lot of issues with BSE's calculation earlier, but now the calculation of BSE and NSE is fairly robust and fine. So anytime it's more than 25p, you must worry. Quality stocks, people are buying, and they have a story, or they have a rationale for it, why they are buying so. Usually, it could be Himachal Futuristic in 2000, or it could be Gujarat NRE Coke in 2007, 2008. The stock has gone down 95% from that period. Absolutely lousy management, lousy stock, no business prospects, but there will be a perfect rational justification why the stock should be bought. And then there would be new themes, new concepts, new ideas, whether it's a .com earlier or real estate, like DLF got listed in sometime in 2007. The Unitech was already listed. So real estate listed companies was a major theme at that time. 2006, infrastructure was a major theme at that time. There were funds, mutual funds, which were dedicated. Tata Infrastructure Fund, they all wanted to invest in infrastructure stocks. So there will be these themes without fundamentals backing them. And you would know by the fundamentals by looking at the stocks which are part of the theme. They would be sporting return on net worth of 3% or 5% or 7%, but they are the ones that are being bought. Why? Because they have a great future ahead, which is the assumption. And as also with the poor quality stocks, these themes also have a very, very plausible, solid explanation. This rationale is perfect. There will be 50-page brokerage research reports which will tell you all about these sectors and why you should go for them. Now, I want to emphasize on this point of overshooting, which I mentioned in the chart just showed about 2008. All right. Now, we can start with an overvaluation. I put 20 as roughly the level at which the market it's like Lakshman Rekha. Below 20, market is not overvalued. After 20, it starts getting overvalued. After 24, it is actually grossly overvalued. So what happens in this market decline, and I've already mentioned this, but just to pictorially illustrate this, it starts becoming overvalued, but nobody cares. At this stage over here, the market is already undervalued. All right? It is undervalued. It's like standing against a train and saying, hey, you're not supposed to go further, but it'll crush you and go further. And it can get absolutely grossly undervalued. A lifetime undervaluation that you would never seen. This can happen. You will make a mistake possibly if you sort of buy at that time, but if you do buy at that time, please do remember that it will shoot to the downside and you can never know how low it can go, and it's not worth knowing. This is only looking back and trying to figure out and get a sense that approximately when it starts getting undervalued, I must start buying. But please do not have a regret, because regret is a terrible thing about in investing. Please do not have a regret that I bought Titan and it was falling and it's fallen further. It will possibly fall further, and you will never know when to buy and when not to buy, because it's impossible to time this. All right. In fact, unfortunately, I don't have a chart. I should have a chart of Titan being bought at that time, which falling further and then going up 400% from that level. In the entire chart, it looks like a tiny little thing over there. It's not worth trying to do your fine tuning in terms of when to buy. So it will overshoot. Please do not have a regret if you were to buy at that time. With this kind of a background, where are we? Let's look at the same list of features that I talked about. There is no multi-year rising trend. All right. August 2013, people felt that the world is going to come to an end because markets were crashing. Rupee had gone to 65 and falling. And Raghuram Rajan came in September 2013. The US investors were pulling out money from the bond market, which is now a new thing. Market always creates new things to learn from. There was no bond market virtually. FII invested bond market virtually in 2000 or 2008, but it's there now. Their investment in bond market is more sometimes in certain months than their investment in the stock market. Why should we worry? Why should we bother? Why should we care about that? Because ultimately it affects the value of rupee. If they suddenly pull out $20 billion from the market, in the bond market, the rupee is going to weaken very sharply. The moment the rupee starts weakening sharply, the equity guys, they start worrying. What is going to happen? Then they start withdrawing. So they are connected through the value of rupee. But that was just 2 years ago. The market has risen only about from December onwards. All right, really from April from March, April, before the Modi government came to power. So we are really talking about a one short period, one short burst with a lot of expectation and the market making a correction. Valuation, market P was 24 in March 2015. It was 22 in September, October, when we said that the market is overvalued and your exposure to equity should come down to about 25% or 15%. This is what we have advocated in Moneylife in 1 year ago. Of course, we were wrong and the market rose further. But ultimately, we are, those who listen to us are having a better time, because over this period, if you had pulled money out from the stocks and put it into a 7% tax-free bond, you still would have been up 7%, where the market is almost come back to the same level with 0% return. A 24p is not a very healthy situation. It doesn't mean that the market is going to crash, doesn't mean that the market can't go up further, but this is a caution. This is a time to be cautious. Fundraising, IPOs, hardly any IPOs. There's one IPO of some Navkar corporation, but now more are coming. Indigo is going to come, and Cafe Coffee Day, and 2 or 3 of these. But this is not IPO mania. IPO mania was 1996 February. 76 IPOs in 1 week. Okay, that is really crazy kind of IPO. All kinds of faltu companies, NBFCs, there's that with a little computer here raising money for the finance business. Retail participation had just started. Mutual funds are getting a lot more money from January onwards. January, February, March, April. The huge amount of money has come into equity mutual funds, some into arbitrage funds, which does not affect directly the stocks because they have to hedge. But still, for pure equity funds, a lot of money has come in, but it is nowhere near get me in at any cost, which stocks to buy, which funds to buy kind of a situation. Hot stocks, P 50 plus, yes, there are. Asian Paints, P was 52, Symphonies, P was 65, Eicher Motors, P is even higher. So there are the little pockets of really high quality stocks, very, very expensive, but only thereabouts. Sun Pharma is not that expensive. Lupin is still not expensive, so only about 40, 42p and so on. So it's not that all high quality stocks people are desperate to get in. Poor quality stocks not flying around. I can hardly see, there are always market manipulation in India. You can always have a situation like Amtech Auto and Castex and so on, but it's not that dozens of poor quality stocks are hitting the circuit, upper circuit, and people want to buy them. That's not the situation as we see today. No new hot themes. Nobody is saying this is a theme, ye chalega abhi, isme current hai. Nobody is saying anything like this. People say that about, as I said, infrastructure earlier and real estate earlier and .com and so on. There's a lot of hot themes in unlisted space, which is once again the .com. So that's hot themes are with the VCs and the private equity guys from in Ola and this and that and so on, but not in the stock market. Current market valuation, why I would be cautious is because of this. All major crashes are linked to periods of very high valuations, and we are in the expensive zone. Is once again to repeat, it does not mean that we're going to decline sharply. It does not also mean that we can't go up and down, but from this level, if you buy index stocks, your subsequent returns are not going to be attractive. You'd rather wait for a little bit of corrections. Now, in May, June 2014, let's go back, wind back a little bit to why we are seeing this situation, and why has the market price not kept up with what we had imagined at that time. Now, we had hoped that the tax laws would be simplified. That was one of the big things that a lot of people were expecting, both individual taxpayers as well as business taxpayers. We expected the government expenditure would be controlled. This is really the monster. It eats up all our money, all right, which leaves very little money for businesses or individuals and so on. We assume that fiscal deficit would be reduced. It is got reduced, but not due to any policy action. It got reduced because the oil prices have crashed. Okay, inflation would go down. Yes, inflation has gone down. In fact, people are talking about deflation now. WPI, which is wholesale price index, is negative now. Interest rates will go down. Effective interest rates on the ground have hardly gone down, despite the fact that the RBI has started cutting interest rates a little bit. Bottlenecks to doing business would be removed. Nothing on this score has happened so far. Manufacturing would boom, because that is supposed to be the expectation. Again, once again, nothing has happened. No steps to simplify taxes, government expenditure not controlled, fiscal deficit target has remained too ambitious, bottlenecks to doing business not addressed, too many schemes, and instead of minimum government, we are seeing maximum government, according to me. And this is the same thing that we saw in the past, which essentially means nothing major has changed. In July, we had a program in Kama Hall after the budget. And I had expressed the same kind of disappointment with the first budget. A lot of people wanted to give this government a little more time. This first budget was done in a hurry and so on. And I felt that, well, you can still do a lot of things. And even the first budget really showed the direction of the government. I had suggested that structural bull market possible if we have, once again, to make the same points, reduce government expenditure, government borrowings, lower taxes. And I had suggested that government should shrink, private enterprises should boom. It hasn't happened so far. But that does not mean well-chosen stocks should not give at least 12% to 15% compounded annual. It has nothing to do with the government. It's the choice of stocks that you're talking about. And if you're able to do that, you would do fairly well. Which stocks and funds in July of 2014? Why am I saying this? Because we are exactly in the same situation. Nothing has changed on ground. The market has gone up on hopes of large institutional investors that something is going to happen to the earnings to catch up. It hasn't happened. We are still in July 2014, and still good quality stocks will give you 12 to 15% return if you are able to tune out the noise. Right? Same thing that I said still holds true. Only high quality stocks, FMCG, technology, mid-cap software, and pharma. All right? And we do favor large cap funds and select mid-cap funds. These are the ones that have actually performed over the last 1 year or so. And the story is still the same. I'm really surprised I missed out pharma over there. FMCG, technology, and pharma. These are the sectors that remain favorites, and these are the sectors that have corrected the least. And that is a message that the stocks are giving to us, that we don't want to fall as much as a Jayaprakash Associates or as much as anybody else over there. Why? I'll tell you why we favor these things. One second. When we look at these, when we look around and try to make up our mind whether the market has corrected a lot, whether it's going to correct further or not, be aware of something which is really insidious, which plays at the back of your mind. You may not even be aware of this. And this, the behavioral analysts, behavioral science theorists call it what is called availability bias. We are always discussing what is available. We are not discussing what is not in front of us. Okay? What is in front of us is what the media highlights, whether there are reforms or not. What reforms? Nobody has even defined what the kind of reforms that you want may not be the reforms that I want. All right? There's no consensus. There's no white paper which everybody has decided. There's no discussion anywhere. So reforms. So people say, you call two experts to television, they'll say, unless we see reforms. One word, reforms. There's no meaning, there's no definition, there's no taking it forward. Government initiatives and schemes, this is what we see. Interest rates cut. Government has to, now there's a lot of talk for the last 8 months is that the real reason why the market is not going up, the real reason why the economy is not doing well is one man, which is Raghuram Rajan. And if only he cut interest rates, everything would be absolutely fine. So reform, interest rate, these are the code words that you sort of exchange with each other, and you know what the other person is talking about, all right? Fed action, whether the Fed is going to raise interest rates or not. There is an analysis I read which analyzed every time the Fed has raised interest rates and what happened subsequently. Each time the market got a jolt, it fell. And every single time, 3 months later, the market was higher. Now the whole of media, entire media is today seized with this worry that Fed is going to raise interest rates and the world is going to come to an end, including people like Swaminathan Iyer. He's been writing an article, since for 2 years he's been saying that the interest rates are too low for too long. First they said because interest rates are too low for too long, what is going to happen? You're going to have hyperinflation. People actually, smart investors like Ray Dalio of Bridgewater Associates was so worried that we are going to see hyperinflation because interest rates were only 1% for such a long time that he pulled out German newspapers of 1913 and 1915 because Germany had suffered hyperinflation at that time, and what stocks did and what the economy did and so on. This is actually documented. I'm not making it up. People wanted to learn what is hyperinflation. They've not seen it in their lifetime. Nobody has seen it. What is hyperinflation? Only some African countries have seen it. All right. So didn't happen. No hyperinflation. No inflation in the US. Now the new thing is that what Fed is going to do. Fed will raise interest rates, and all money is going to go out of the stock markets and into bonds or wherever, US treasuries, God knows where. Now, you have to look beyond this. This is the thing that we hear from them, and this is the thing that we worry about, because we are exposed to only this. We have no alternatives to discuss or talk about when we are thinking of the markets and what is going to happen, what are the forces that's going to shape the market movement from this time onwards. Now, my point is very simple. You can know about it. Can you control any of this? Is any of this in your hand? What are you going to do even if you know that this is going to happen or not going to happen? Again, has anybody, any of the analysts being called by CNBC to talk about Fed action, have they tested what happens when interest rates go up? Do stocks actually go down? When do they go down? What are the other conditions unnecessary? Interest rates going up, stocks going down. Multiple conditions have to be satisfied. It's not a one-to-one correlation between these two factors. And there is no discussion on analysis of any of this. Some of this, as I said, is even vague or completely irrelevant. We need to stay focused on what we can do, what is actually in our own hands. Okay? This is what we can do. We have to choose stocks of companies that are earning high return on capital. This is the one mantra that you need to know in the stock market. All the money that has been made, or the stories that you hear about Rakesh Jhunjhunwala or Nimesh Shah, my good friend Basudev Das is sitting here, he can corroborate that all of these people made money in the trading and invested in multinational stocks in the 80s and in the 90s. At a time when people were talking about Tata Steel or Motor or Loco or Tata Locomotive or this, they used to make money in the trading and invest in Gillette, Procter & Gamble, Hindustan Lever. These are the kind of stocks they bought because these are the companies that made high returns on capital. This is a tested, proven model. It can never go wrong because there is an economic basis for this. Look at this. This is a chart. This is two tables of this year. Okay? Top 15, bottom 15. If there is any correlation anywhere, even if loosely, not a hard and fast, almost 80% correlation, it is this. If you look at these stocks, all these are low return companies. When I mean by return is return on net worth, or in case of banks, or return on capital employed in case of non-banking, that is manufacturing or services companies. Low return is roughly related to higher decline. Higher return companies is correlated to lower decline. The average return is 29%. This average return. Maximum is 4%, minimum is minus 59%. Average return is minus 7%. Look at this. Where is minus 29 and where is minus 7? This is the only correlation that works in the market. There's one more factor, which is of course valuation, but I'm not going into that because individual valuations you'll have to figure out for each of these stocks. If you buy a high return company at a high valuation, you'll have to wait for a longer period. It's better to buy Asian Paints when it's quoting a PE of 25 rather than buying Asian Paints when it's quoting at a PE of 50. But leave that aside. And Asian Paints over 7 years is not going to disappoint you. All right? Whereas no matter when you buy a Reliance or an NTPC or a Tata Power or whatever, you probably are not going to make too much of money. This is one correlation that works. Once again, this is the correlation that has worked even for the recent decline. Yes, about that big bull run which everybody expects, which lifts all boats like a tide, which we haven't seen so far. If we had seen so far, we would have got a little worried, of course, but I'm sorry, it's all gone haywire. Here it is. We had only one multi-year bull run in 23 years. One, which is 2003 to 2008. Okay? We had a multi-year bear market from 94 to 2003. Okay, and we also had another multi-year bear market. 2010 November, when index was Nifty was around 6,300, and August 2013, almost like 3 years, market did nothing. It actually fell. The reason is, we tend to believe reforms, growth will lead to bull runs. No matter how disappointed we are with every single government about reforms, this is what our eyes are fixated on. This is what our heart of heart wants. This is what we believe. According to me, this is absolutely a foolish dream. This is not going to happen. Okay, so anybody who tells you that we're going to have a multi-year bull run, and I see a lot of successful investors also say this. I don't know what they actually do when they invest, and when they buy, when they sell, we never know. They'll tell you India is on the beginning of a multi-year bull run. According to me, don't believe it, and it doesn't matter. The reason it won't happen is because the governance model has remained in India the same for the last 23 years. Okay, which is high taxes, increasing government expenditure, maddening laws and rules. We are helpless against global factors. Somebody tweeted me the other day, when is it that India is going to influence this world stock market than China influencing? I said, not in our lifetime possibly, because none of these things have changed. The governance model has remained the same for the last 23 years, which is why we had only one bull market, a multi-year bull market in 23 years, all contributed by money coming from abroad and starting from an incredibly cheap, inexpensive market in April 2003 when index P was 12. That means, now this is sinister. This is a nasty piece of conclusion, but I'm afraid I have no way of avoiding this. Existing businesses who have already built a franchise, a company like, as I said, Asian Paints or Sun Pharma or whatever, these companies which are doing well, they are protected. They are protected because competition is going to remain low. New guys coming in easily, they can't, first of all, starting a business in India is just incredibly difficult. All right? New guys coming in easily and taking on the established players is not going to happen so easily. The government doesn't facilitate, not deliberately, but the result of all the government action is this: there is going to be enough of money pumped into the hands of people. Why? Because you're going to have a pay commission, you're going to have this or that. There's a large government force. There are a variety of ways in which money is flowing out from the coffers of the government into the hands of the people. And on the other side, to take that money and make a high return on very little capital against very little competition are going to be the likes of Nestle's and the Asian Paints of the world. All right? This is the story, and the story is not going to change. The story we thought would change last year. There's going to be more people, more competition, and so on and so forth. It hasn't happened so far. So high quality companies will always command a premium. One of the big conundrums of this bull market, which started in last year and went up in index going up to 30,000, is why is it that foreigners were mostly buying a Symphony or a Asian Paints or an Aisha Motors, which are so expensive? According to me, this is the reason. Because these businesses have no threat. There's hardly going to be any threat to them in the near future because of a variety of reasons, including, I'll just leave, I think I'll have just one chart to move to the, quickly to move into asset allocation. Old chart, old slide, still valid for a long time. For tax saving, you should use Public Provident Fund and ELSS. For fixed income, if you're in a tax bracket, use tax-free bonds. For growth, equity funds and stocks. If you're a taxpayer, for non-taxpayers, this is the ratio. I'll leave the chart with you for a little while, and I recap. No signs that we have seen excesses which lead to a severe decline, as has happened in the past. No sign also on the other side that we are in the beginning of some kind of a major multi-year bull market, unless you see really drastic changes coming in from Delhi, which means more of the same. What I said in July, what was valid in August last year, what was valid 3 years ago, which is high quality stocks in 3 or 4 sectors, which is pharmaceuticals, software. Thanks to rupee, software is really facing a lot of trouble, but as long as rupee is weak, they're safe. And consumer products, mainly fast moving consumer goods, are absolutely the stocks to buy, right? So thank you very much for listening to me. And if there are any questions, please fill out the feedback form. If there are any questions, please ask. Yes.
Sir, as you said, in the last bull run, the PE was approximately near 50 level.
No, 26, 27.
No,
27.
not this one. Previous, somewhere long back, about in 2000.
No, 2008 was 27.
Okay.
And 45, 50 was 94.
94. So 45, 50 was the PE in 94. So is it possible in this information technology time now also that again the Sensex will touch that PE level? Is it possible? Please.
In market, anything is possible.
Thank you.
But there are, and we can only know with the benefit of hindsight, right? But no investor should be investing with the hope that you invest at 26 and it goes to 50. That's not a very rational investing decision.
Thank you.
Yes, please.
Thank you very much for your very lucid explanation of the market, which probably nobody understands.
Thank you.
Can we make some sort of a mobile application?
Mobile application.
Yeah, to understand, because there are various factors which are, to be taken into account, and we always go wrong. So, to make our analysis better, I mean, to decide decision making this thing. Now that there is.
I saw the other day in Economic Times that a mobile app developer with 3 years to 5 years experience is making 8 lakhs to 10 lakhs a year. So there is a bubble in mobile app space. So if somebody funds us, we'll definitely do it. But we can't pay somebody 10 lakhs a year to do a mobile app.
Debashis, that was a fantastic presentation. My question is that in your second last slide, is there a bull run? You said this government's policies is pretty much the same thing as before.
Yeah, from the market perspective, it is the same as before.
Yes.
Only from the market perspective. There are different perspectives. Maybe from another perspective, it is better or worse. But from stock market perspective, it's the same.
Okay, so my question is that we had a previous seminar on Make in India. Right? So that actually gave us a very rosy picture of what they are planning and pretty much a fundamental change from what previous governments have thought about.
Right.
Don't you think that is going to be, that's going to affect the market?
See, that's a completely different thing altogether. See, there are multiple dimensions in Make in India. One of the things that Mr. Amitabh Kant spoke about is ease of doing business. All right. Now, 2 factors in ease of doing business is entry and exit. Right. So if he sets those 2 things right, a lot of small businesses will probably be a little better off. From the stock market perspective, it's going to take a lot more than that. It's going to take a lot more than it's not in his domain, because if land is not available, he can't do anything. I mean, he's trying his best. He's a fantastic guy, and he's got his agenda well chalked out. And there are 6 factors in ease of doing business. 2 are these, and then there is laws, for instance. Enforcement of rights, for instance, which is India is one of the worst.
I'm in manufacturing, so I really understand.
Yeah. So exactly. So property rights can't be enforced so easily.
I have 2 questions. One, you showed in the last, or one of the last slides, that non-taxpayers should be investing in PPF.
Yeah.
Now, I have not quite understood why you say
PPF.
that, because, yes.
No, I said PPF and because PPF, because that gives you a guaranteed return of 8.5 now.
To my mind, if I'm in the high tax bracket by investing in PPF, which is exempt.
No, it was tax-free bonds, PPF and tax-free bonds. I had suggested PPF and tax-free bonds.
And tax-free bonds,
for taxpayers.
Okay, my main question is that on the one hand, you said about existing companies, established companies rather, will continue to do well. It's very hard for new companies to come in and compete and grow. On the other hand, you said that select mid-caps. Now, while theoretically, yes, but in a scenario like that, almost it's very difficult indeed, if not impossible, to select a mid-cap that will really grow against all that competition and against better economic environment.
It is my view, and it needs to be tested, but from what we have seen is that there are certain characteristics of mid-cap companies which are a little more attractive than their competitors. Usually these companies are in export. Okay, so it's very difficult to find the next Nestle in a mid-cap space. It will be very difficult. But you will find companies which have got a niche in the global market. They may be small, but they have either technical excellence or they have excellent relationship with the buyers, so they are relatively better off. And if rupee doesn't become stronger, rupee remains weak, which is possibly likely, even at a oil price of...
Small IT companies or mid-cap IT companies, they've done well.
Yeah. No, there are a lot of companies. I mean, I can discuss, I don't want to mention them over here because it might be construed as me advocating those names, but there are lots of small companies which have done extremely well in the export market. And I would say that is a real strength, because to tough it out in the global market and to create a niche for yourself, that's really the core strength that shows.
Yeah, hi Debashis, it was a very helpful presentation.
Thank you.
Would like to know, one should invest in stocks or in mutual funds?
I have done a whole session on this. It's there in YouTube. Just go and take a look at it.
Okay.
In short, stocks. Last year I would have said it depends, but now I'm quite confident that you should invest in stocks and not mutual funds. But in short, I'll tell you for 3 reasons. One is that they don't take care of buying, while buying stocks, they will not take care as much as you do. Okay, I've noticed this. There is a general lack of, it's not unethical, but lack of complete commitment. Number 2, they have to benchmark themselves, which is why a lot of benchmark stocks are in their portfolio, for the only reason that they don't want to, their performance should not be too much, either too high or too low compared to the benchmark. This is a wrong way of investing. If the benchmark stocks are not the stocks that I want to buy, why should I buy them? Just to be close to the benchmark, to the index. And third thing is, institutional investors like mutual funds never ever make an effort to time. I'm in favor of timing. So you, as an individual investor, by tuning out all the noise and remaining calm and taking your own time to pick stocks and buy at the right time, you're going to do much better than mutual funds.
So you mean to say we need to time the market when the good quality stocks are down?
Time the stocks. For instance, we wrote a story just about 3-4 issues ago. Again, no hint of corruption or unethical behavior, but I think it's extraordinary that HDFC mutual fund in one scheme sold forgings at 70 rupees 2 years ago and bought the same forgings at 700 rupees 2 years later. This is what I mean by they don't care. Forgings can still become 1,000 rupees, but you will not do it if you are a diligent investor.
Good evening, sir. My question was somewhat related to his, but I will put my second question. What is your take on the gold bonds which are just going to be coming up? And second thing I wanted to ask is stocks, mutual funds, he said, or the government bonds which are just being said, okay, it will come, but it's never coming.
See, there is at the fundamental level, investing is only for 2 reasons. One is safety of your capital, one part, and one part is the growth of your capital. And you should never mix the two. So you can say that I want to keep 35% of my capital safe, and when you decide that, you make sure that it's really safe and not into something that moves. Okay, your bank fixed deposit figure doesn't move from month to month. It doesn't go down, it goes up possibly. But if you buy a debt scheme or a bond scheme, which has a buyback or which is listed, it will move. So you're flouting the fundamental principle of 100% complete capital protection on the fixed part. Then you should focus on the growth part. And within the growth part, there's nothing that is better than good quality stocks. And you should never mix the two, as I said. So put your growth part of the money, how much, doesn't matter how much it is. It can be 5%, it can be 85%. Depends on your risk appetite. Put it in good quality stocks. The other part, put it in a product that is not going to go down, at least over the period that you need. So gold bond scheme and whatever, returns are low and it's neither here nor there.
Hello. Thank you for the presentation. You said about PE. There are many individual stocks in quoting at a very high PE ratio. So should one wait for the correction to happen for investing? Like the individual stocks like Lupin, Torrent, and Sun Pharma, they are quoting at a very high PE ratio. Even in FMCG like Nestle and all.
Ideally, yes.
Your opinion?
Because I've always found that anything that you buy expensive, either you, it's not only formula, right? It's all how you behave as well. Behavior is far more important than abstract formula that we are discussing away from the market. You buy an expensive stock, it falls 15%. Stocks can fall. It's in their nature to fall. What would you do then? You would curse me, saying that he had said, good quality stocks, buy for the long term, but I'm down 15%, what should I do? So you will do something. You may be itching to do something, which is get out. If you get out, it may fall further and you may feel vindicated. If it doesn't fall further and goes up, you will have a regret, right? All of these things will make you do one wrong decision after the other. You will be worthless. And the best way to avoid all this is definitely to wait for a time when the stock that you are buying is reasonably valued, either because the overall market is down or something wrong has happened to that company temporarily and you are lucky to have got it at a low price. One of these things. I am in favor of waiting and being patient, because the single most factor that determines the returns from stocks is the price you pay. There are only two figures. Cost, there's nothing else. No CNBC, EP, me, anybody comes in the future. You pay $100. That's it. These are the only two figures that make sense.
Pricing is important.
Yeah. Price is the single most important factor, and it is the only factor that is in your hand. There is no other factor. I am more confident about pharmaceutical stocks. Yeah, I am less confident about software stocks, but except that the weakness of in fact, if the government takes its reforms seriously, which means that we have a situation eventually, like the temperature, eventually the thermometer for the economy is the rupee. Okay, if rupee is on a strengthening situation, software stocks are going to get decimated. They're just like any other company. Yeah, but pharma companies have a strong domestic component. They can adjust. They are manufacturing over there, right? And then they have these, discoveries, new ANDAs. They're called new drug discoveries. So those new molecules give them a tremendous boost from time to time. Yes, it depends on individual companies, but most of these Indian companies like Dr. Reddy's, Sun, Lupin, all 3-4 of them are now have gained a critical mass. They're able to attract the most interesting piece in this whole thing of Ranbaxy taking over, Sun Pharma taking over Ranbaxy, is the fact that the Sun Pharma owner didn't go and negotiate in Japan. He had an Israeli who So Indian companies today have reached that kind of, this is a very, very significant small factor. They are seen as global companies, and they are smart enough to present a global face.
Good evening, sir. Thank you so much for the presentation. We always look forward, to your insights. I have two quick questions. Brazil got downgraded recently. Russia is in shambles. China, no one knows about it. Europe and US, we are not talking about it. In this case, and during these times, can India command a premium? Can this 23 PE be the new 30 PE or something? Talking about the same high quality stocks. And second quick question would be the age-old argument or discussion about the diversification versus concentration portfolio.
Well, there are two components to this, to evaluation. One is, what a natural market level of valuation is, given everything in, even in the worst kind of situation, 2011, everybody thought that Europe is just going to break apart, Euro won't survive. All these predictions turned out to be wrong. Even at that stage, Indian 4-quarter trailing P, when I say P, it's a 4-quarter trailing P, which is available in National Stock Exchange website or BSE website, was around 17, 18, right? 4-quarter trailing. So there is a natural level for stocks, and this I learned long ago in a company called ACC, which was loss-making, but still, and 100 rupee share was still quoted at some 1500 rupees or so, and I was asking around. I didn't know much about stocks at that time. At a very high P, loss or hardly any profit. So I realized, and then also Siemens. I remember sometime in 1996, Siemens declared a loss, and the stock went up. Right? And I was most surprised that something like this happened. There is a natural level for stocks, and therefore a natural level for the market. Unless there is an event where people are panicking for no reason or valid reason, doesn't matter, and they're not thinking. Essentially, they're not thinking what is the valuation, whether I'm buying. They just have to sell for either because of panic or pressure, one of the two. Unless you have that kind of a situation, the natural level of Indian market P is about 17, 18 or so. Okay, so you could wait. Some of the stocks that I was looking at a stock like Torrent Pharma, and this was there as part of my earlier presentation on stocks versus mutual funds. And the entire period that Sensex was down from November 2010 to August 2013, Torrent Pharma was up, since you mentioned Torrent Pharma, that's an example I'd taken, was up some 150%. So there are about, in our database, there are about 350 odd companies which we look at. I mean, we don't have the resources to track like the analysts do and produce fact research reports. But these 350 companies all of them have a return on capital employed of 11% or more. Okay, this is my cutoff. And very often I would find, either because of some event or some reason or the other, there would be 3 or 4 stocks which are reasonably valued, very reasonably valued, no matter what happened. And of course, many of them would be very expensive, like Symphony, which just shot up to 2008, 300, 400, I don't remember how much, I think 2,700. So there's always opportunity in the market, provided you shortlist companies based on pure fundamentals, and you're agnostic to specific sectors or whatever. These are favored sectors, and because it's a large gathering, we can't go into individual stocks. And I'm saying that if you follow these principles, high ROC, these sectors, you will be fine. This is roughly my message. We really want to pick stocks. There are always opportunities in that set, and today these. We pay for a database and we have these, but for somebody who today people have access to something like screener.in, which is a website where you can screen your stocks. You can say, show me stocks with a 15% plus ROC. You get a list, and you can make up your mind on which are the ones, and then put P against that, and see which is a low P. So high growth stocks, good quality stocks, P of around 20 are available. It's not that they're not available.
Debashis, see, you in your presentation, you had mentioned several things. Now, I want to compare it with what actually happens in the market. What actually happens in the market is that of all the activity that takes place, 95% is futures or options trading. That's essentially trading. So we are talking about that 5% where you may say people are investing for whatever periods of time. Now, again, if you look at the investable stocks, considering that 5%, you'll see that the bulk of them, from your definition, may not be investment grade. And the investment grade. And the ones which you think are really good businesses, like Nestle and others, that their P/Bs are so high that it takes an enormous amount of time to get a return out of it. In fact, juxtapose this with what you mentioned about Mr. Jhunjhunwala, that he made his money out of trading and then invested it in the stock market. Would you suggest that most of us... I know where you're going. Do you think we should suggest we take more interest in trading, then after having made the money, then we take a look at...
Absolutely not. These are hardcore. They are brokers. They spend, dream, breathe, talk the markets all the time. They used to. I mean, some of them have left the market, but these are all stockbrokers first. They were living, I mean, literally been in Dalal Street. And trading was much easier then. I will take a lot of time to explain, but some of them were even indulging in unethical practices. So, it was physical transfer. Sometimes transfer deeds were not available. The stock price would shoot up. So all kinds of things are happening. I'm not saying that contributed to their entire trading profit. Insider trading, there were no laws against insider trading. So that's only for really hardcore, core professional investors, no matter how you make the money. My point was on part 2. Invest in high quality stocks for the long term. That's what they've actually done, and we have demonstrated proof that works. Is all I wanted to say. Second point, which is your first point, is that it entirely depends on the time frame. So if you, unfortunately I don't have the chart, but if you pull out a chart of Asian Paints, in fact this happened to me today when I was finally looking at the charts, and I was looking at stocks that have fallen. If you take a monthly chart of Asian Paints from, let's say, 2005, 10 years, you will have to really look for that period when, that January to 2008, when the price actually fell. You have to take your cursor and look for that place, because the chart looks like this and this. In the larger scheme of things, an overvalued stock falling because of global crisis on a 10-year horizon is not identifiable in the chart. Apple computers fell 50% in 2 days. And this is an example I had given long ago in, way back in 2003, 4 or whatever. When you look at Apple's chart, a 15-year, 20-year chart, you will not be able to find that period. 50% not identifiable. Because the price has gone so much higher, it's a blip on the screen. So I always say, people say buy for the long term. I have a definite period because I've studied this. It has to be 7 years plus. Okay, I used to say 5 years, 2 years go. Because the market is expensive, I have made that period 7 years. Because I've studied and I've found that high quality stocks with returns of this kind, which Hindustan Lever is 112%. Every 100 rupee is coming back as 112 rupees every year. Look at the incredible profits, okay? So these stocks, even if they are expensive, if they are held for 7 years or more, is going to be the best investment across all asset classes. And I'm quite certain about that. Within that 7 years, there will be a crash, a correction, whatever. If you're able to, on an average, we've studied this. On an average, a market decline is about 15%, 15.5% to 18% is an average market decline, which is what we suffered. All right. So if somebody had bought it when the market had declined by 15%, it would be a good time to buy good quality stocks. Asian Paints fell from 850 to 700 or 720 or so and so, or whatever. If you want to optimize, you don't need to optimize. But if, you say that I have a salary every month, so I can't buy all of that I have to buy every month. So buy on the month where there is a market decline. That's your SIP. That's your systematic investment plan in stock. And if you do that, you're buying at different prices. And it might seem preposterous, but it does not matter over 7 to 10 years if you buy high quality stocks, even at high prices. Not only us, we have studied this across. We have not put it out in a blog or whatever, but Professor Sanjay Bakshi has actually put this out. He has given example of 4 or 5 companies in his blog, a blog called fundoprofessor.com. He's given examples that his own example, 113% return in 1 year, I sold. And the stock moved up 1800% after he sold. All right? So net 7 years plus, high quality stocks, you're not going to regret.
Thank you for the presentation. It was very informative. Couple of sectors that you mentioned about the worst sectors, like the reality or the metal index. Now, they are all below 10 PE, roughly, on an average. So, does this mean that they're going to stay like that?
They stay like that.
Does that mean it's going to be staying like that? Because we have always been listening to the thing with be greedy when people are fearful about it. If everybody is selling metals, for example, is it not the right time to get into metals? I mean, your views.
Well, Samir Arora used to say the PE of a stock indicates the number of years it's going to last.
Tata Steel has been in existence for more than 100 years, sir.
And more seriously, there are 5,000, 6,000 listed companies, right? And you can buy anything. It's your choice. It may even go up short term. It may even go up over a 3-year period. Jindal Steel and Power were an incredible run it had from 2003 to 2008. It had combined both. It had steel as well. Steel was in great demand. Global steel prices were rising, and it had power, which is like a fixed income for the company. It had access to mines, which are subsequently cancelled by the Supreme Court. I'm saying 350 companies in India have 11% plus ROC. And we calculate ROC after a lot of adjustments, so it's a much more stricter criteria. So leave the details aside. Why would you want to look at anything other than so many high quality companies which are listed in the market? 1. 2, there are methods to buy highly oversold stocks and sell them after they have gone up, after they have corrected upwards. That is only for hardcore trader or a hardcore professional investor. It's not even for mutual fund managers, because they don't have that skill. They don't know what to do, when to buy, and so on. For an average investor, it's absolutely suicidal to even think of buying a poor quality stock just because it has fallen a lot. It absolutely makes no sense. It's lottery. You are playing with your money against a completely unknown, unknowable future. It's better to go to the casino. You can at least have fun. There's not even much fun in buying a Jai Prakash when it's falling. There is no established method or process of doing what you're saying one should try to do, except for professional, as I said, real hardcore traders. If they have developed a method, they can do that.
Good evening, sir. Thanks a lot for a very nice presentation, and you have dispelled our fears of whether we are on the threshold of a crash, and naturally everybody is asking what to buy instead of what to sell. I would like to know whether you have some ideas and means to identify tomorrow's Eicher Motors and Page Industries, and so that we don't buy them now, we buy the ones which are going to be Eicher Motors of tomorrow.
The good question is to go and ask Vikram Lal whether he himself had thought that Eicher Motors would be what Eicher Motors is today, 10 years, 15 years ago. There are two kinds of information. And information which can be used prospectively, and information which is all fun and games when you look at it retrospectively. So an Aisha Motor and a Page Industries is all, getting a kick out of this. If I had bought, look at the stock, look at the chart, daydream a little bit. I have absolutely no way of knowing. Not only, I've said, that's my first point, not only me, even the company promoter has no way of knowing. And I have dozens of examples of the opposite. Ratan Tata had called all his dealers in 1997 for a big conference in Lucknow, where they had a plant, to tell them how many of you guys are prepared to double your supplies, because I'm going to double my production over the next 2 to 3 years. The monthly vehicle sales of Telco of that year were peaked in March 2007. That peak did not come until 2005. 8 years. Okay? Forget about you and me. The company management itself doesn't know what's going to happen over the course of the next few years. This is their own assessment. Did he know what will happen to Europe and US when he bought Chorus? Did he know what would happen to US and Europe when he bought Land Rover and Jaguar? Company management themselves, they have to make a reasonable assessment and look for the long term and bet. If you are looking back at a select list of companies which have gone up, you are not looking at companies that have gone down 95%. You are looking at selectively only those companies that have sharply gone up, and you are trying to find characteristics, if we can, and see where we can find those characteristics. They just do not exist. It is not possible. You can only, to go back to the question that I did not answer, you can expose your money to a set of well-run companies with a high return on capital and hope to beat inflation and make much more. That's it. And we should be satisfied with that.
Sir, several people are giving trainings, including Mumbai Stock Exchange and Allocation Institute of Mumbai, or to the newcomers entrance in the stock market. Why not you arrange some training for us, of course, for fee in your institution? And second question, recently, including some of the leading newspapers have appreciated that the High Court case that you have won against the National Stock Exchange. So such thing that it may happen in other stock exchanges also. So I just request you to highlight that thing. Thank you, sir.
Okay, if you come across, we'll highlight again.
How our market will react under two conditions. First, if Fed hikes the rate, or if it doesn't hike the rate.
I don't think market is going to react either way. If it doesn't hike the rates, these are all short-term predictions. And short-term predictions are like a toss of coin. It's all completely random. I think the market is going to sort of go up a little bit if it doesn't hike the rates. It will then focus on the next thing. Market is like a little child. At any one time, it has got one focus and it wants to grab that. It can't grab, then the next one. So the next focus is going to be domestic rates. Okay, whether Raghuram Rajan is going to cut rates sometime in the policy in September. If it does hike rates, it's going to be very small, 25 basis points. Market will fall, stabilize, and go up. Because 25 basis points doesn't do anything to anybody. It's a signal, all right? And as I told you that based on past studies, other things being the same, if they're not same, then obviously the conclusion is different. Other things being the same, higher interest rates do not necessarily lead to lower stock prices. On many occasions, in fact, on most occasions, they've led to higher stock prices, but over 6-8 months. But most people don't have the time or the patience to look at previous examples and draw conclusions. They go by these set answers, preset answers. Oh, high interest rate, stock should fall. So there will be an initial knee jerk. Yeah, no other questions. Any other?
In the last issue you have mentioned about owners' earnings.
Owner earnings. Okay.
Owner earnings. Now, how do we get hold of the figure of maintenance capex? Because that's something which is not really reflected, because the company might be expanding also, so there could be expansion capex also.
Difficult. It's a very difficult question. You need to first shortlist the companies that you want to analyze, and then go into the balance sheets and see what kind of expansion. Even some of the expansion is also maintenance capex, some parts of the expansion. So you really need to read up a little bit on that and go into the individual balance sheets and see what each company is doing of your shortlisted companies. Okay, so no other questions. I'll close this session. Thank you very much once again for coming here.